I'm Mark Boris, and this is Straight Talk.
Chris Joye, welcome to Straight Talk.
Thanks for having me, mate.
You're still the, I know you downplay it, but you're a portfolio manager. This is what you like to describe yourself as, amongst many other millions of things that I know you do, which we won't talk about today. Portfolio manager at Coolabah. Tell me a little bit of a story about Coolabah in terms of what you are doing now. Like, what's Coolabah doing right now in terms of its investors?
Yeah, so we run 15 billion across about 50 portfolios. I have 53 professionals around the world. We have offices in London, Miami, Auckland, Sydney, and Melbourne. I'm smiling because you've known me since I was at university, and you've kind of backed me the whole way along. So I really appreciate your support, Mark. But
it's got nothing to do with me, mate. But you've done it all on your own. By the way, for those guys who don't know, that this bloke is the most dynamic, hard-working bastard I've ever met in my life, and he's got a million ideas, and he actually executes on them, which is the reason I backed him. I did it purely out of economics from my own point of view, and I did very well out of him. So don't get him wrong, don't misinterpret. But I did back him, and I believe in him, and I've known his family for a long time too. But mate, what are your portfolios covering off now? So originally we did an enhanced cash fund, but you got a lot more things going on now.
Yeah, so today we run enhanced cash strategies, long-short credit strategies. I mean, we do everything in fixed income, sovereign strategies. Today we're the biggest trader of Aussie Commonwealth government bonds in the world. So we are about 5 to 6% of the total market turnover. I think we're bigger than anyone, according to my guys' estimates. But I have 53 guys around the world and girls. We have 12 traders, 19 analysts. And we really specialize in just pricing the correct or fair value interest rate for a bond to pay us. So it could
Australian be assets, huh?
Global.
Global assets.
Very global, yeah. So 2/3 of our trading, we trade about $1 billion a day. Last year we bought and sold close to 150 billion. And but our edge is we're highly quantitative. So we have 80 different bond pricing models we use around the world. But really what we're trying to do is conceptually simple. What interest rate should CBA pay us on a 3-year senior bond, or ANZ pay us on a 5-year subordinated bond, or Australia pay us on a 10-year government bond? And we do that all around the world, all day. And we're incredibly active, very systematic, very quantitative, and just very rigorous in figuring out what the fair value interest rate is. And what we really want to do, mate, is find a bond paying 7% that should only pay 6.5%. And when that interest rate drops down to our fair value target, we get a little bit of price appreciation, and then we rinse and repeat.
You get a capital gain.
Yeah, get a capital gain, exactly. And then today we do offer strategies that actually have very high yields as well. We use some gearing. So, our floating rate high yield fund, which is also available as an ETF, the ticker is YLDX. It's paying about a 7.5% weighted average interest rate on its portfolio. And the portfolio is ostensibly very high grade. So the portfolio is 70% major bank senior ranking bonds and 30% major bank subordinated bonds. The average credit rating is very high at A+. It's daily liquid. It's floating rate, but we use about 65% gearing to boost the interest rate. So the bonds are paying about 5%, and we're getting 7.5% because we're using that gearing to boost the interest rate on the portfolio. But Coolabah Capital Investments, we set up in 2011 with a lot of help from you, and your nephew Luke still works for me. We were just talking about the fact that Luke, if you're listening, mate, you could emulate your uncle's aesthetic appeal and dress sense. Luke's really struggles with the way he presents himself. No, but
that's because of his father. He's my brother.
Yeah,
I blame my brother.
Yeah, Adrian. But Luke's our chief operating officer, brilliant boy, and. So yeah, that's kind of what we do. We just trade. We trade, more actively in Australian fixed income, I think, than any other party locally. But we are, one of the most active traders in the world. So over the last 24 hours, we probably traded $1 billion Aussie in the US and European bond markets. And that's why we need a global team and global offices. We just opened up the Miami office. We've got 10 guys in London, 5 traders in London, 5 analysts in London. And no one really does what we do. Like, we're very differentiated in terms of our approach. Typically in fixed income, it's just you hold to maturity. You buy a bond, you get the yield on the bond, less the fees. You don't trade it around. And if you want more yield, you take more risk. You take more liquidity risk or more default risk or more interest rate risk. And we don't do that. We focus on super liquid bonds that are very low volatility, that are floating rate, that really don't have any default risk. and we generate the total return through trading. So in the last 12 months, our floating rate high yield fund and our long short credit fund would have returned 9 to 10% after fees, and they're currently paying yields around 7.5%.
So that means, by definition, you've got to understand interest rate markets. You and your team, that is. So let's talk about Australia. We're in the middle of an election period, so it's a bit tricky. But let's park the election period to the side. Today, on the day we're doing the podcast, we got a Reserve Bank board meeting, and there's probably no point, because by the time this goes there, the decision's already going to be made. But if I look forward to May, the May meeting, which I think is around 17th or 18th of May, off the back of the April numbers, which will be the March quarter numbers, which are pretty important to come out. Where do you where are you guys seeing the official rate of interest rates in Australia? And I'm not talking about bond markets. I'm not talking about BBS. I'm talking about just the official rate, which off the back of which home loan rates get set. Where do you see official rates for the calendar year of 25? And you can tell me subject to this, subject to that, because of course we'll be subject to the data. Where's it going?
Yeah, so in 2023 and 2022, we argued rates need to go a lot higher. And I think some folks were calling for rate cuts in 2023, and we said, no, they need to go higher. And the RBA only lifted its cash rate to 4.35%. Pretty much every other developed central bank, New Zealand, Canada, the UK, US, went to 5.5%. And in 2024, there were a lot of calls for rate cuts, rate hikes. The inflation data was pretty brisk in 2024. It actually got revised up. If they'd had that information, the revisions, they almost certainly would have hiked once more in 2024. But when they had that opportunity to hike, they didn't see that revised data, but they didn't cut in 2024. And that was our view, was they're either going to hike in 2024 again, or they're not going to cut. And a lot of people, the market, for example, the financial market, Mark, was pricing in quite big rate cuts from the RBA last year. And we said, that's horseshit. That's not going to happen.
Even at the beginning of the year.
Yeah, you're exactly right. Like at the start of the year, and we look at the Fed, at the start of the year, the market was pricing in 175 basis points of rate cuts from the Fed. And we said, that's BS. It's not going to happen. They're going to cut by a fraction of that. And the market was pricing the Fed starting to cut in March, and then they had the RBA a bit later than that. And of course, the RBA didn't cut at all, which was the right decision. And the Fed only started cutting in September, and they only cut by 100, and now they're completely on the sidelines. But in December this year, we started publishing I wrote a weekly column for the Financial Review. I started saying in the AFR that I thought they'd cut in February. Why?
Yeah, what changed your mind?
Yeah. So not the data per se, but in December, the RBA completely changed their tune, and they surprised everyone. They shifted something called an easing bias for no reason. But we thought we figured out why they shifted. And that was because we knew in December the inflation data the next month in January, and they met in February, would be soft.
You're talking about the December quarter?
Yeah, December quarter. Yep. Yeah. So the December quarter data.
0.5 trim mean, I think it was.
That's right.
Yeah.
Very good memory.
Yeah.
Yeah. So we knew it was going to print 0.5.
Yep.
Well, that was our forecast, and we'd published that number in December. And for statistical reasons, there was good grounds to believe the final quarter of 2024 was going to be a soft print.
So just explain, Chris, a little bit more about that. So just for our audience's sake, because I mean, he's one of the fastest talkers I know, because he's one of the fastest thinkers I know. But just to put it into context, explain why 0.5 for the December quarter, in other words, for the last 3 months of 2024, giving you a 0.5. Why is it important relative to where the Reserve Bank wanted to be? It wants to be between 2 and 3. Why is that the case? That quarter? Why is that quarter so important?
Well, that a 0.5 outcome would imply that on a short-term basis, the core inflation rate in Australia was actually hitting the bottom of the target band.
Like around 2.
Yeah, exactly.
4 times 0.5.
Because they target officially the midpoint of 2 to 3. So they target 2.5.
Yeah.
And 0.5 is actually at the bottom of that range.
But is that correct? Can I suggest that? But historically, though, they've been only interested on the historical inflation number, which is the 0.5 for that quarter. But every other quarter before that would have given you a 3.2.
Correct.
But why did they change? Why do you think they changed their?
Well, so this is the little puzzle.
Yeah.
Okay. So
this is a puzzle I don't get. So,
I think it's very easy to understand what happened. So Michelle Bullock a few weeks before the December board meeting, had said we need at least 2 quarters of soft inflation data or positive inflation data to be comfortable that we can lower rates. And then in December, we all wake up and she turns around and says in her statement after the board meeting that basically they've adopted an easing bias and they're laying the groundwork, we felt, to cut in February. And there was only one new data print available between December and the February meeting, which was the January release, which was the fourth quarter data. So she kind of had busted her own decision-making rule that she'd announced only a few weeks prior. So you take the fact that you've got this inconsistency in their messaging. Why are they so keen to set up the grounds for a potential easing in February? And the fact that they knew and we knew that we were forecasting a 0.5 trim mean print, and it printed to 0.5 for the fourth quarter, which was implying that, it was annualizing around 2. But crucially, the trajectory of the data was, heading, even though the 12-month rate might have been above 3, the trajectory of the data was heading towards their target. And remember, they think that the normal or neutral interest rate in Australia is around 3.5. There have been some recent reassessments of that where it might be closer to 3. But if they're at 4.35 and they're, they think that through the cycle interest rate that is neither stimulatory for the economy or contractionary is around 3.5, you can mount the case if you're them and you want to cut and you're a bit dovish and maybe you're a bit politically compromised, that it would be pretty nice to kind of punch out an interest rate cut in February, knowing that an election would be held after then, and that cutting in the middle of an election in April would be difficult, right?
Which is now.
That's the situation we sit in. So we did not think they should cut. So I was very clear. I wrote this repeatedly in the Financial Review, and I think everyone understands this. We said we don't think there's any case to cut, but we think we think they will cut in February. So we forecast the February cut.
Okay.
Yeah, 100%. We're very, very clear. I wrote it repeatedly. We don't think they should cut, but we think they will cut. And people were a bit confused because we've been very hawkish in 2024 saying no cuts and no case for cutting. But I knew people would get confused, so we made it very, very explicit that we thought they would cut in February, but we didn't agree with the logic, right? Because by her own logic, she needed 2 quarters of data, and suddenly she's very comfortable with 1 quarter of data. And the key point is the 0.5% trim mean print was statistically biased. So all the smart forecasters knew that it was going to print soft for some statistical reasons, right? So it wasn't necessarily a high quality signal. And then they cut in February. So then this all begs the question, the puzzle is, well, why did they cut? If you know what we know, which was maybe it was statistically biased, the cost of living subsidies that Jim Chalmers has given the community and that the state governments have also replicated, they are sandbagging the inflation data. They're artificially suppressing the inflation data. They're doing that deliberately to try and get the RBA to cut, and lo and behold, they've cut. But obviously when their cost of living subsidies expire, the data pops back up. And my simple kind of calculus is Chalmers appointed Michelle Bullock. So he single-handedly selected her, and it was a controversial appointment in the sense that he was expected to appoint someone outside of the bank, and he went for the insider. So he hand-selected Michelle Bullock. He hand-selected her deputy, Hauser, and he's appointed a lot of the board members. And now there's this new committee that will set interest rates that he's also selected.
So do you think it was political? Do you think there was – I don't think he I'm not asking did he ring her up and say, listen, I want a rate reduction. But I have to tell you
we now know, actually, the Financial Review's published a lot of information on this. He's jawboned the heck out of the RBA. Like, he's absolutely put them under enormous pressure. And you got to remember, his idol is Paul Keating. He wrote his PhD on Paul Keating. And Paul Keating was famous for jawboning and haranguing the RBA. And so I just think he's pulling straight from the Paul Keating playbook. I actually don't have a huge issue with it at all. Like,
Costello used to do it against the banks.
Yeah, like there's a lot, people say that the RBA is politically independent. The politicians shouldn't give them heat. I agree. Like, the politicians shouldn't create too much heat for them. But if he wants to have a go and say, hey, here are all the reasons I think you should cut, I personally think he's entitled to make that case. So if Jim Chalmers is listening, I would just say, dude, I've got no problem with you harassing her. But he did. Like, that's very clear. The AFR's published a lot of stuff showing that, my understanding is he put a lot of pressure on the board, and he has an appointee to the board. He's Treasury Secretary as well. So Steve Kennedy sits on the board.
But that board didn't meet that. But that board didn't meet at that meeting, though. The new board didn't meet at that meeting. The meeting at this meeting, at the April meeting, but they didn't meet in February meeting.
No. But Steve Kennedy sits on the
current board, the old board. Yeah.
Who works for Chalmers.
Yeah.
Chalmers has pressured the RBA much more directly than any recent treasurer.
Except for Paul Keating in the 90s.
Yeah. But by the way, again, I'd say I have no problem with that.
I think it's appropriate.
My mate John Keir at the AFR, he appropriately, says that that's inappropriate. I think I can perfectly understand how people think that's inappropriate, but I say fair play to Jim Chalmers. Like, if I was in his shoes, I'd probably be putting pressure on the RBA. I've got no problem. He can make the intellectual case. Like, we have free speech. Sure, we recognise they're politically independent, but there's no problem with politicians prosecuting their intellectual agenda. Like, I think he should be doing everything possible. If he honestly believes, and he probably does believe, that rates should be lower, and our mate Stephen Koukoulas has argued, forever and a day rates should be lower. He obviously is very sympathetic to the Labor cause.
Although he and I disagreed on that February meeting, because I said, based on what they've done historically, we will not get a rate reduction in February. I think we'll get it later on in the year. But I didn't know.
Well, he knows. I was consistently, we publish relentlessly from December onwards.
He and I discussed it. Kooky and I discussed what you've been publishing.
Yeah. So we called the February cut very, very clearly. But coming back to, I think the interesting thing around the political nexus is what we know is Chalmers has put a lot of pressure on directly on Bullock and on the board. But I think that's fine. They can make their case, but the RBA needs to be big and strong enough. We're all grown, men and women.
So were you disappointed in the way she came out in a press conference after, because she then sort of looked like she was resigning back from her position?
It's ridiculous. I'm disappointed in the
RBA.
So the RBA there was no intellectual or evidentiary basis based on their decision-making framework that they'd set up, that we need 2 quarters of data a couple of weeks before the December meeting. And then suddenly something happened in December where they were laying the foundations for a political cut. It was a political cut because they knew they were going to get that soft print, and that was the perfect excuse to cut. And as soon as they went to that easing bias, the market had it 70% priced. And they know that if the market's got it priced, then it's very hard for them not to cut, because they can then say, well, the whole world thinks we should cut.
She boxed herself in.
Yeah. No, but that was deliberate. Because what the RBA says, well, market expectations, every bond trader on the planet thinks we should cut rates. It's obviously the right thing to do. And so they cut rates. And, by the time they came to the meeting, I think it was 80% priced. And they could have eviscerated the pricing. It takes 30 seconds for Bullock to stand up in January and say, oh, we did. She has no problem. And on numerous occasions, and she did this after the February meeting, saying she thought that market pricing was junk. So she could have set up that conversation prior in January. At any point in time, they could have said, and this is another reason why I was very confident they were cutting. They did nothing to dispel market pricing, and they often do.
They did no preconditioning.
No, well, but they just have to give a speech and say, well, respectfully, we completely disagree with market pricing. They do that all the time. They didn't engage in any of that rhetoric.
So that's a big lay down misère then.
Yeah, it was lay down misère. That's why we were kind of that's why I was saying is lay down misère. But interestingly, and this is where it gets all the more absurd, after they cut.
That's what I'm saying.
They never cut more than just once. That's just, an irrelevancy.
They never cut only once.
Yeah. So they never cut only once. I think I said more than once. Yeah. So they never only cut once.
Yeah. It's a
and
series.
After they cut, the most ridiculous narrative was, it's kind of more or less one and done. And that market pricing, which was for a very, I thought, reasonable, and Kooky and I would, I think, be at one with this, the market was only pricing 2.5 more cuts throughout the whole year of 2025. And she said, market pricing was unrealistic. And she and her proxies at the RBA went out on this campaign to completely dismiss market pricing. I just think it's madness. So if you're going to cut once, presumably there's a case, you want to move the cash rate meaningfully and materially, and 25 basis points is not meaningful and material, and does nothing to the inflation data according to their own modelling.
It certainly does nothing to promote anything either. It's not.
So where it's a little complex and nuanced is this: one cut statistically does nothing, right? However, I argued prior to the cut that one cut is meaningful. I thought they'd cut more than once, and I think they will cut more than once. I think they'll cut in May. There's a possibility they cut today. I think it's less than likely today. We're in the middle of a campaign, so they're not going to cut today. But
there's not enough data around.
I think there's a good chance they cut in May. And
can we just look at that just before you go on? Just in terms of the rest of the year, can we just look at May? What do you want to see in the April? Probably comes out 27th, 28th. With the April numbers for the March quarter, what are you looking for? What do you think they're going to be looking for? More importantly, to justify a cut in May.
So the kind of question is: does core inflation print at 0.6 or 0.7? I think it could print either. I think the risk is to a lower print. And I think they could cut on either. And I think there's a good chance they cut. Like I think it's 67% probability they cut. I think market pricing is actually there or thereabouts.
I think it's 60%.
And I think there's really interesting dynamics at play with the Aussie inflation data. But just before we come back to that, I just want to square away this point on the single cut. The single cut is meaningful in this respect. And I wrote this repeatedly. I think I wrote it twice in the Financial Review in January. It radically changes the atmospherics, the zeitgeist. And what's amazing, and I expected this to happen, is if you look at the house price data, dude, if you go to CoreLogic's website, and you go to house price indices,
I've done it.
If you go to the what is called the back series, and there's a chart, it's a dynamic chart, and you can deselect all cities or select cities. And if you deselect every city but Sydney, and you look at the chart, what you'll see is house prices fell by about 2%, soft, but like house prices rose in Sydney about 18% from January 23 to September 24. Massive boom, right? But from September 24 through to the RBA meeting in February, they fell 2%. But more or less the week they met, they started rising again. And they look like a straight line. They're rising quite quickly now. House prices are increasing again. And exactly the same thing's happened with even greater force in Melbourne. So house prices in Melbourne only rose 5-6%. Very different situation between Jan 23 and about March 24. But they started falling earlier. I mean, Victoria's a bit of a failed state, like basket case, lots of problems. And so the housing market's been much weaker. And so house prices in Melbourne, I think, they started falling in March and they fell all the way through to the RBA meeting in February, but almost perfectly synchronously with the RBA meeting. If you look at that chart, it looks like they're rising. They've risen 1% already just since February. So the housing market has reacted instantaneously. And that's why one cut's meaningful, because it changes the narrative. Rather than people debating about hikes or rates remaining high for long, suddenly we're talking about cuts, and how many cuts. Is it 2? Is it 3? So your question is how many this year? I think they'll try and chisel out 2 or 3 over the course of the year.
And what are they going to be looking for?
And I think the risk is they do more. Yeah. And I think the game changer for my view is the election of Donald Trump. So I had no strong view on who would win the US election. We didn't. That's not our wheelhouse. We don't do political forecasting. So we just trade, the data as it materializes. But once Trump was elected, we had very strong views. Those views are first, and this was a very contrarian view. We told everyone who would listen, I've written 1 million times in the AFR, he's dead freaking serious on tariffs. He's not negotiating. There's no out of the deal bullshit. Trump, and it's quite complicated. And I'll come back to why he's dead serious on the tariffs in a second. But there's big implications for Australia, mate. Because what's going to happen is you're going to have these huge walls erected around the US economy. And the Chinese aren't going to be able to sell jack shit into the US economy. They're going to block China from the US economy completely. So what are the Chinese, our biggest supplier of goods into Australia is China. And if China can't sell BYD cars into the US, where do you think they're going to dump their cars and all the other goods? Little old Australia and the EU and other markets. But we're going to get a ton of cheap Chinese goods dumped into Australia. Are we going to do anything about it? If they are in turn eviscerating our manufacturing, not that we produce cars anymore, but if that's impacting our ability to compete against the Chinese, is Albo going to do anything about it? No chance. We've got no spine on this stuff, right? So we're going to have actually a lot of, I think, deflationary forces.
Cheap goods.
That result from the trade war. So it's counterintuitive because you think trade war prices going up, inflationary. It's very inflationary for the US. But if you look at the Peterson Institute modeling, and I've written on this 6-12 months ago, or actually not after the November election, I wrote on this. The Peterson Institute modeling, when we tear apart the data as we've done, shows you get deflation in Australia. Prices actually fall because the cheap goods get dumped on us. So what does that mean for the RBA? Well, you got 2 things. China's, can you say fucked? On this?
You can say whatever you like.
Yeah, cool.
It's my podcast.
Okay, cool. China's fucked, right? Their economy is just like I've said China's uninvestable for over a decade. You know that.
Yep.
Probably about 15 years I've been arguing that. And they're going to get so screwed by this, right? They're going to be blocked from the entire, from most Western liberal democratic markets, they're going to be blocked from, and but particularly from the biggest market, which is the US. And so that's not good for Australia. So you have the Chinese economy, which is already struggling. That's going to be amplified and really exacerbated by Trump. He's going for the fucking jugular, right? Trump is a killer. And literally and figuratively, because he doesn't mind running those special forces operations, taking out guys in Yemen, or Soleimani, the Republican Guard general, the Iranian who was he was leaving at Baghdadi airport, and Trump flew 2 Hellfire missiles into his convoy of cars and assassinated him. He likes his little assassination programs, old Trumpy. I'm not saying I agree or disagree. I'm just saying he likes that stuff. He likes it. He was saying, he gave an interview the other day. And he goes, "You don't understand. I am a bad motherfucker." He didn't use the word motherfucker, but he's like, "I'm a bad man." It's funny, another story about Trump. Apparently, he was sitting with the Taliban leadership in person before they evacuated Afghanistan. And he looks the head of the Taliban in the eye and he says, "We're going to leave Afghanistan. But if there's one hair on one head of one American soldier that's in any way adversely impacted," and he pulls out a photograph, and he said, "This is your home. This is where your wife and children live. We're taking them all out." Oh. And apparently they didn't do diddly squat. So that's a bit of a segue. But
and some people like that.
Yeah.
That show of strength.
Yeah, they do. Yeah, they definitely do in America.
So you're saying that Trump's non-negotiable on the tariffs. The tariffs are going to build a wall around America and make everything much more expensive in America, potentially.
But for Australia, coming back to Australia, so the Chinese economy is going to really get pounded.
Yeah.
And that's bad news for Australia.
Now, why is it bad news if everything arrives here cheaper?
Well, that's positive. But, if she's our number one trade partner.
But we have to export back there.
If we're exporting, commodities to China, then that's not very good for us.
Well, we are. 70% of our stuff goes to China. So resources I'm talking about. So what you're saying is that if China's struggling, our export will start to suffer.
Correct. Now, she may try and stimulate. So President Xi may try and compensate for this, which paradoxically could increase demand for commodities. But, the way the RBA, I think, will look at this is not positive for Australia. Like China, having a quasi-recession of sorts can't be positive for Australia. And then the other thing is you're going to get a deflationary impulse. So the prices of goods will be lower than they otherwise would be. And I think it's already starting to happen. And so what that means is for the RBA, they could cut in May quite comfortably. The inflation data could start surprising on the downside, particularly if they extend these cost of living subsidies, which they seem to be doing. And you could get a decent number of RBA rate cuts, but 2 to 3, I think, as a minimum, makes sense for this year in total.
So a lot of people talk about, a cash rate, which you mentioned a bit earlier, but like sort of cash rate, which sort of settles down around 3.5%. And let's say inflation is like 2.5%. There used to be a concept of net zero or something close to zero, with the difference between the inflation rate and the cash rate. And then unemployment is sort of around, let's say 4. Yeah. Can you see a period, like this is a bit weird to me, it seems a bit weird to me, but then wage growth is the same, around about 3.2, 4.2, around that territory. It seems to me that we've sort of got a restructure of where all our numbers are sitting. They're all going to sit somewhere between 3.5 and 4.5. Unemployment, wage growth, inflation, cash rate, blah, blah, blah. I mean, a cash rate might get to 2.5, but it's going to bounce around a little bit. I've never really seen that before in the past. Do you think as a result of COVID, we have a restructured statistical environment, or is this just a reaction to what happened during COVID and we'll go back to our old system, our old structure that we used to have in the past, like 20 or 30 years of inflation on average between 2 and 3, like since 96, I think it was, or something around that territory. We had like nearly 25 years of inflation around that number.
I definitely feel like we're in a more inflationary environment globally. And I think that will actually ultimately reassert itself in Australia. So, the tariff impact on inflation is temporary. And so therefore the deflationary impulse that we've been talking about in response to the tariffs could also be temporary. But I think it's, the prevailing kind of atmospherics for 2025 are going to be potentially quite friendly for the RBA in the context of giving it the capacity to cut rates. But I think what's changed since the pandemic is the size of government. Government spending as a share of the economy is the biggest since World War II, basically, in Australia. And, if you look at jobs, 57% of jobs growth in Australia over the last few years has been accounted for by
Public sector.
Yeah, well, not just the public sector. Sorry, just 3 sectors within the public sector. Health, education, and public administration alone have powered almost 60% of all jobs growth. And there's no change in that dynamic. So what's fascinating, I think, for
Is that around the world though too, not just here? I mean, just
globally,
generally.
yeah, globally. But and that's a key point. The difference in the US is they've had some cathartic crises. They had arguably a tougher pandemic. They definitely had a much tougher 2008 crisis. Like they had a huge increase in unemployment. Unemployment barely budged. We didn't even have a recession in Australia. They had a much, much tougher 2001 recession in the US. We haven't had a proper recession since 91. But the key point is Australians, I think, are really in the throes of Dutch disease, or what is known as moral hazard, which basically means we've been this wonder down under that's been incredibly fortunate for a crazy amount of time. And that good fortune has been driven by probably 3 key things. Huge endowments of natural resources that have made us very rich because we can sell them to the rest of the world for high prices. And then at the same time, we've been lucky that there's been a commodity price boom. Secondly, we've run the strongest population growth in the developed world for about 30 years, and we continue to run a crazy strong population growth. And population growth just brings demand into the country initially because these guys come with money often, and that's a net demand shock. In the medium term, the population growth actually expands the pool of available workers, and I think this is what's happening with the wage data. In contrast to, say, the US, where they're deporting people and the borders are closing, in Australia, we've got people rushing into the country. And that's actually relieving some of the pressure on labour costs. And we needed that because in the pandemic, we'd closed our borders and the unemployment rate was incredibly low, the lowest in half a century or thereabouts. And labour costs had obviously accelerated. But resources, population growth have been the 2 key drivers of Australian prosperity for a long time. But then finally, our physical amenity. I mean, Australia is the most beautiful country in the world, and the physical amenity is incredible. And then with super now taking 12% of our wages, super poured a huge amount of money into infrastructure, as did governments. And the quality of Aussie infrastructure is, like, I think, coming up to, it looks second to none. If you look at just the Sydney, the tunnels, the metro railway, the light railway, the way we've equipped our cities and the quality of our cities. You go to America, anyone travels to America, you look at the poverty, the crime, the just the dilapidated nature of the infrastructure.
Well, San Francisco is a basket case.
And this
LA is too. And
this is the point, Mark. In the US, you've had crises. So if you look at California, it's a failed state. LA and San Francisco, increasingly uninhabitable.
Which would be weird because it's the 7th largest economy in the world.
Yeah,
as a state,
and huge fiscal crises, like massive budget deficits. Then juxtaposed against that, you've got the counterfactual, which is Texas and Florida. Yeah. Budget surpluses, thriving,
low taxes,
businesses are moving there, population growth is strong, low crime, and so I think that contrast between New York, California, the Democrat states and the Republican states has galvanized this kind of intellectual crisis whereby the Trump Musk paradigm is on the ascendancy, and they amazingly, Musk is probably the only guy in human history who could do what he's doing right now because he's the richest.
Just doesn't give a fuck.
He doesn't give a fuck, and he's the richest guy in the history.
That's what I mean. He doesn't give a fuck.
Yeah, so he was worth over $400 billion US, and but he does give a fuck in this sense. His singular mission is to get to Mars. He wants to create, an interplanetary species, and he thinks government is the key obstacle to getting to Mars. So I think what Musk's insight has been is government, NASA, everyone, regulation is just blocking our progress in our capacity to get the human species sort of civilizing Mars. And so therefore, what do I need to do? Well, I need to get a sympathetic leader, somebody that I'm backing. So Musk more or less helped Trump win the election. And now that he looks like he's living in the White House. He's sort of permanently appended to Trump's hip. And Musk has the solutions to almost all of Trump's policy problems. Trump wants to cut taxes, but that costs $8.1 trillion US over 10 years. Now, unless you find revenue to pay for the tax cuts, issuing $8.1 trillion of debt would create a huge debt crisis in the sense of just much higher interest rates. They can pay the interest, but you get a massive increase in US interest rates. And that would be potentially catastrophic. So he needs the tariffs to pay for the tax cuts. This is what people didn't understand. He wasn't bluffing on the tariffs. He's dead serious on the tariffs because the tariffs he announced to date raise about $2 trillion of revenue.
Which allows him to give tax cuts to the wages.
So $2 trillion revenue means he's only if the tax cuts, that's over 10 years.
Yeah.
If the tax cuts only cost 8.1 trillion over 10 years, he only needs to now find 6 trillion, right?
Which means cut costs.
Yeah, but the tariffs are important for another reason. Basically, I think the US judges that over the last 30 years, the Western world took the view of there was a lot of vainglorious hubris post-World War II, which was democracies defeated socialism. And we have the dominant political and business model. And everyone in the world is going to buy into that model. And they're going to embrace it. And they're just going to become acolytes of our belief system. So the idea was we'll do free trade with everybody. We'll reduce tariffs. We'll get rid of protectionism. And the Russians and the Chinese, when they look at the prosperity in Europe, the UK, US, Australia, New Zealand, Canada, there's no way in the world they can't embrace that prosperity. So they're going to trade with us. They're going to reduce trade barriers, and they're going to ultimately migrate their political systems away from authoritarianism to democracies. Well, the Russians and Chinese basically, I think, thought we were pretty gullible. And so they just used those free trade opportunities to appropriate intellectual property, to use state-subsidized firms to build market share, control markets, build national champions, companies like Huawei, BYD, etc. And basically Western manufacturing shifted to China. The supply chain shifted to China. Remember, we used to talk about outsourcing. Outsourcing was great for Western companies because you could build it in low-cost China and bring it back to the US, and everyone benefited. The Chinese benefited and US consumers benefited through lower costs. But at some point, the penny dropped that the Chinese weren't going to sign up to the Western liberal democratic business model.
Philosophically, no.
And they weren't actually playing by the rules they had agreed to play because, the Chinese government was giving their firms all these unfair competitive advantages. And Musk is the best example. He builds a factory or factories in China, assuming he's going to sell zillions of Teslas to the Chinese, the biggest consumer market numerically in the world. And the Chinese just steal the IP and create a bigger, badder, stronger EV company called BYD that starts decimating Tesla's market share. So Musk's naivety created this monster in the form of BYD. So the Americans basically realized, actually, we need to reshore or domesticate all of our manufacturing. We need to bring back all the supply chains because now there's also security dependencies on the Chinese. I mean, the Chinese are making things that we use in our military kit, and we actually now recognize we may end up in a serious kinetic conflict with the Chinese. So Trump's plan with the tariffs is probably, if you don't believe in free trade, it's the right plan. And the other reason it's the right plan, and nobody understands this, is the US economy is an autarky. And what that means is it doesn't really trade with the rest of the world aside from the Chinese and their proxies like Mexico. So the US, we have a statistic called trade intensity, which is exports plus imports divided by your economy or GDP. And US trade intensity is only about 25%. The average advanced economy is 60 to 70%. The EU is 100 to 110%. And so the US doesn't really need to trade with the rest of the world if they bring their manufacturing back, which is what they want to do. And Musk has proven with SpaceX and Tesla, you can manufacture in the US, particularly now that everything's robotic. Labor costs are not such a big deal anymore because it's all automated. So that's the plan. It's the right plan because the US is the heart and hub of all the research, innovation, and genuine sort of entrepreneurship and commercial and business insight. And so it makes sense that if you can't trust the Chinese, you've got to bring your manufacturing back. That'll net benefit the US. And then basically, so they bring up all these tariffs and they say to the rest of the world, if you produce a good in a country outside of the US, you won't be able to import it into the US. We'll make you cost ineffective or we'll put you at a competitive disadvantage. So I think companies have now signed up to $2 trillion of manufacturing spending in the US.
In other words, move their business to the US.
Yeah, they're going to bring all those businesses back to the US. So
like BlueScope's a good example. They produce steel in the US plant. So they're not importing or exporting to there.
Yeah, so everyone's going to do that because the tariffs is going to, otherwise the tariffs will kill their businesses. Now, so
that's smart.
100%, super smart. So they're going to trade with themselves, erect these huge trade barriers, rebuild all the manufacturing capacity, and then at the same time nobble the Chinese, which is geostrategically important because the Chinese were growing big and powerful because they were stealing Western market share and stealing Western clients and innovation and IP. Now, the final piece of the puzzle is Musk. So at the same time, one of the big problems we have in society is just the growth of government. Again, there's been more jobs growth in Australia in the last few years in the government sector than the private sector. And Musk realizes that there's just massive corruption inside these bureaucracies, and there's huge overreach, which is crushing innovation, it's crushing entrepreneurship, it's crushing idea generation, and it's basically crushing productivity and prosperity. So Musk is the only guy in the world, probably in human history, who's got the ability to go in there, and he did it with X or Twitter. He cut 80% of their workforce instantaneously, and he built a better product.
Yeah.
So because he's the richest man in the world, he rocks up and he says, I want to get to Mars, but I've got to remove the public obstacles. At the same time, my mate Trump has promised 8.1 trillion tax cuts. Well, if I just reduce government spending, this is Musk's model. If I reduce government spending by 15%, which is not that much. You and I have run businesses. We run businesses. You know, if we have to cut costs by 15%, done, easy, right? If we need to. Now, in the US, you've had untrammeled, historic, unprecedented government growth for decades, right? But particularly since the pandemic. So you cut it by 15%, you raise $1 trillion a year of savings. Now, the US budget deficit is less than $2 trillion. So you halve the budget deficit. So over 10 years, you're basically generating $10 trillion of savings. So Musk's cost-cutting program alone pays for all the tax cuts and some, right? And the truth is, like, I reckon they could cut government spending by 30%, like if they really went hard. So 15% is probably just the beginning. Now, the problem for the global economy, the problem for interest rates, and the problem for Australians is this, and for your super balances. They've got to do the government spending cuts fast and hard because they've got to do them before the midterm elections in November 26, because otherwise at that point they could lose control of Congress.
Unless you get an extended period. But yeah, they're working on that now.
So they want to
get a third term.
No, this is the midterm election. So
I'm sorry, but they've got a short period to get all this done, is your point, yeah?
Yeah, exactly. So they want to get it done hard and fast. So the government spending cuts, they've already done $135 billion. And so there's obviously a lot more coming. So that comes hard and fast. The trillions of dollars in new manufacturing investment, which will create a huge growth engine, that's going to come later. So you've got this asynchronicity in the timing of, you get a negative demand shock. So they're destroying public spending on the one hand immediately, but on the other hand, the growth engine comes later. And so what that means is you probably get a bit of a recession in the US in the next couple of quarters, or at least a growth air pocket. And that at the same time probably emboldens the Fed to start thinking about cutting rates. You will get this temporary inflation shock, but it is temporary. Yes, consumer inflation expectations are elevated, but I think the Fed will probably continue cutting rates, particularly when they see the negative growth data from the DOGE initiative run by Musk. And then the other thing is the trade war is creating mayhem in markets. So US equities have dropped 10%. NASDAQ's dropped 13%. People are very risk averse, very nervous. So you might say, well, what about his tax cuts? Well, chances are people are going to save a lot of those tax cuts and they won't spend them. So I think in the short term, this is very bad for markets because markets can't see past their nose. Okay. Markets are going to focus on the growth shock, the fact that companies that service governments are not going to be earning nearly as much money, all those consulting firms, all those building contractors. I mean, all the service providers to the US government are going to get butt bashed by Musk. And that's short-term very negative. But in the long term, it's super positive because you're going to get this massively revitalized US manufacturing industry and trillions of dollars in new investment in productive equipment that's going to create a lot of autonomy for the US. The US won't be relying on anyone by the end of this program.
So given that, what would you say to Jim Chalmers, who may well end up getting re-elected, along with with his party, and what a form of government is? What one question would Chris Joye ask Jim Chalmers that you would like to hear Jim Chalmers address publicly? Because Jim's going to be here next week, and I'm going to ask him.
Well, I mean, the hard questions...
Policy question I'm talking about, of course.
Yeah, the hard questions for Chalmers is, does he actually care about reform? Or is he really just interested in power? He wrote a PhD, but not on economics. He wrote a PhD on Paul Keating's politics, his power politics. So the first question is, does he really care about reform? And I think if you judge them on their actions, they've massively increased government spending. The budget's lurched from surplus to deficit. We have a problem in Australia where government spending is now the highest since World War II. And interest rates, paradoxically, would be a hell of a lot lower in Australia were it 100%. Not for all of this government spending.
Yeah, correct.
And the problem, here's the really kind of far-reaching problem.
You should just explain it, because effectively the massive government expenditures propped up the economy, which makes it look a lot better than it really is.
If the public sector wasn't accounting for most of the jobs growth, then unemployment would be much higher. Yep. Wages growth would be much weaker. Inflation would be lower. But the demand, I mean, Aussie economic growth has, in recent years, been mostly accounted, if not 100% driven by public spending. So the problem for Australians is we have no productivity, and Chalmers has no solutions as to how he's going to grow productivity. And what is productivity? Because productivity sounds like economist jargon. Productivity is just entrepreneurship, innovation, idea generation. Productivity is just doing business smarter.
Encouraging people to take risks.
It's basically producing more with fewer resources. Yeah. That's what productivity is. And 100% encouraging people to take risks to establish a disruptive business that's going to produce more or the same amount that other people's
for less.
So therefore, you can produce more cheaply, and therefore you can undercut your competitors and appropriate market share. So the problem that Chalmers has is he has no solution to the fact that we have the worst productivity in decades. And Australia is mired in a massive productivity problem. And in the long run, that's disastrous. It's kind of like Dan Andrews. Dan Andrews in Victoria spends crazy amounts of money. In 2019, just before the pandemic, the Victorians only owed the rest of the world 50 to 60 billion. Today, or within a few years, they'll owe close to 300 billion.
Wow.
Back, in 2020, when Victorians borrowed money as a government, they paid an interest rate that was very similar to what the Commonwealth pays. Today, they now pay 100 basis points in extra interest because no one wants to buy Victorian government bonds, and they're likely to be downgraded. Queensland is likely to be downgraded in our view. New South Wales is likely to be downgraded. And because we haven't had a cathartic crisis, because we don't have yet a California, although Victoria is heading that way, or a San Francisco, there's no counterfactuals. And because there's so much public spending, the government of the day is actually conflicting economically the voters by showering them with all this cash. But they're making Australians very complacent, very, very lazy. And this is the Dutch disease that we were talking about earlier. The fact that we've got really dumb growth in the form of huge, commodity exports coupled with really, very primitive population growth. None of that is productivity. And productivity is the only thing that can grow wealth. And again, I don't even like the word productivity. Entrepreneurship and innovation is what drives prosperity. And we don't have that in Australia. Tax rates are going up, not down, arguably at the margin, particularly once you adjust for indexation or bracket creep. And I think what you'll see over the next few decades is that Australian businesses will leave Australia because we're going to become so uncompetitive to the rest of the world. You'd be much better setting up in Singapore, Dubai, Abu Dhabi, Italy, Portugal. All these ascendant countries are doing tax deals to attract the best and brightest businesses and brains. And people are moving. Like, Nico Kane, I think his name is. He was the top guy at Macquarie Bank. They paid him over $50 million a year. He resigned to take a job in Dubai. Why? Because presumably he can get much better economic incentives in Dubai. So the top Macquarie banker doesn't want to live in Australia, notwithstanding he's presumably a very proud Australian who loves, like we all do, the amenity of living in Australia.
So I know a lot of people doing exactly the same thing. And by the way, you can always buy Australian assets too, so it doesn't make much difference. The Australian assets are still available for you to buy, but you're operating in a different environment where you pay less tax, it's much more efficient, lots less regulated, and you have access to many other parts of the world. As a market economist, it struck me whilst you were talking, was, as you know, the regulator in Australia requires lenders in Australia, it doesn't require, but suggests to lenders in Australia that they apply a threshold of 3% over the prevailing over the lending rate when they're assessing a borrower to buy a house. And the suggestion is that, like, if you do what we say, then you will have to hold less capital. If you don't do what we say and your portfolio is, you're lending your threshold, the extra amount that you look at in terms of person's ability to service that loan is, say, if you only apply 2%, then as a result of that, we might ask you to hold a little bit more capital against it because we think that loan might be more risky or the portfolio loans might be more risky. One of the things I don't like, and I know I have a kindred thought process with you on this, is to some extent that plays right into the hands of elitism in Australia, because only the elite can afford, and the elite's kids can afford, which by the way are our kids, to borrow those amounts of money because we have to top them up. We're always going to be topping them up, which, you expect parents to do if they have a capacity to do it. But the problem is, in terms of affordability, affordability is not just the price of the property, but it's the ability to pay for the property. In other words, borrow the money to buy the property, because most people borrow anyway. So given the market interest rates at the moment, and they're more likely to come down than go up. What do you think about the 3% threshold sitting on top of people's ability to borrow and or servicing, our servicing assessment? I see Dutton's come out and said it's unfair. What do you think about that 3%?
Listen, I think it's a good example of a situation where there are probably much better models that regulators, and our regulators have not covered themselves in glory recently, particularly APRA, which is responsible for this regulation. There's many more dynamic models that could apply that would result in better outcomes for everybody. So 3% as an extra interest rate buffer that banks apply on your serviceability test when figuring out what you can afford to repay.
How much will lend you therefore?
Yeah, how much will lend you therefore, and therefore what property you can afford to purchase. That made a lot of sense when the cash rate was at 0%.
Yeah,
because obviously the cash rate could have easily increased by, as it did.
It did.
And with the benefit of hindsight, it increased by 425 basis points. But when the cash rate's at 425 basis points, or at the time it was at 435, it made no sense. Right, or very little sense. So it should be dynamic. That serviceability buffer, I think, should be dynamic, and it should be calibrated according to where the cash rate is at any point in time. So I definitely think at this point in time there's scope to lower it. Yeah, I mean, here and now you'd say prudently at least by 100 basis points, right? It's hard.
And they used to do that, but I don't know why. We haven't changed for so long. And the only other question I have for you.
But by the way, on that note, I mean, I think Jim Chalmers and Dutton they control APRA, and they can absolutely say, hey, we don't agree with the serviceability buffer, you should change it.
Well, Dutton has said that. Dutton has said he's going to start that off.
But APRA, sometimes the RBA and APRA, RBA is a little bit different because they are meant to be avowedly independent of the government apparatus, but certainly ASIC and APRA, but APRA in particular of late has made some funny decisions, some odd decisions, like phasing out the hybrid market is one which has never been done before anywhere in the world. If I was a smart politician, I'd just say, dudes, it makes no sense to whack 300 basis points on top of a 435 cash rate. We're going to cut it to 200 and see how things go, and potentially we'll cut it a little bit lower, maybe down to 150.
Because if it all of a sudden increases a massive amount of borrowing and house prices,
go berserk.
You can go and change it again. You can put it up to 2.5. You can say you can calibrate. And the only other question I had for you is, if you don't mind, if I just grab you before you go, because I know you're busy and I've got to know the podcast as well. But you talked about policy. You talked about has Jim got serious policy? Does he really want to make reform and make changes? What do you think about the concept of, and a lot of people are talking about it, and Matt Common's been talking about it. I mean, a lot of people have been talking about it for a long time. I have too, about having an adjustment in the GST from 10 to say 15, but let's assume it never goes above or below. But you adjust the GST in lockstep with the RBA making changes, so that up or down, so that everybody gets affected and/or everybody gets the benefit of it. So during a period when we're trying to dampen spending, instead of just putting the RBA putting up the cash rate, which puts up your mortgage rate, on top of that, whoever it is puts up the GST rate. 5 basis points, 2 basis points, 20 basis points, whatever it is, trying to make sure that they affect everybody, because, we have these conflicting markets. We have all the people with mortgages who are paying more, and then say someone like, your parents who might be still alive, don't have a mortgage, have money in a super fund, blah, blah, blah. They're not affected, and therefore they're out spending like drunken sailors and taking the trips to Ballin and Bali and spending money in restaurants.
Yeah, I think it makes a lot of sense. If the RBA was doing it,
RBA should do it.
Yeah.
What do you think about that as a potential Chalmers policy?
Yeah, I think it's a great idea. Like if the RBA was doing it, it just gives them more tools, more levers. It would be more broad-based. It would probably reduce the amount by which they had to increase interest rates for a given impact. I do think that we would be better off with a higher GST and lower income taxes.
Me too.
We're better at having a fair, flatter tax regime where the guy that works harder than his contemporary who chooses not to work hard doesn't end up paying. He'll always pay more tax because he's earning more income. But how's it fair that he actually pays a higher percentage of his income in the form of tax than the guy that's choosing not to work hard? That's kind of perverse. So this tax regime where we get taxed proportionally more the harder we work.
I know what they call a progressive tax system.
Yeah, is a massive disincentive for innovation, entrepreneurship, and productivity and prosperity. So coming back to Chalmers, I think the problem in Australia, we've got a huge moral hazard. I feel like there's a lot of complacency in the community. Young kids, have incredible lives. There's no unemployment. Wages are very healthy. There's massive amounts of public support. NDIS is supporting 1 in 10 kids. And I think that the problem will be 20 or 30 years hence. And I think there's a little echo of this in Dan Andrews in Victoria. So Dan Andrews decides to spend more money than any Victorian has in the history of the state. And government's a solution to every problem. But now increasingly it's looking like a failed state. No one wants to live in Victoria. People are leaving. Businesses don't want to operate in Victoria.
Taxes are high.
Taxes are high and rising everywhere because they're having to pay for the debt. Victoria will shortly be paying about $12 billion a year, or circa 3 to 5 hospitals worth in interest payments alone on their debt. So they've gone from, again, 50 to 60 billion in debt to close to 300 billion in debt. And none of these guys seem to have any solutions for the long term. They just seem to be optimizing for, I want to win the next election. I want to become prime minister. I want to be, maximize my personal power. I think a lot of these, there's a self-selection bias in politics where you get a lot of, narcissistic individuals who are not actually genuinely interested in policy reform. Even the smart guys.
We don't need to mention him.
No, but I wasn't talking about my mate Malcolm Turnbull, just for the avoidance of doubt. There's others on the left side of politics that probably fall into that cohort. But it's funny. You know many more politicians than I do, but I know a lot of politicians, and finding the guys that are actually, really earnestly committed to making the world a better place. It's hard yakka. All these guys are the kids who are at uni who are doing student politics, yapping around, trying to kind of self-promote themselves to advance their personal power and control and influence. So I think politics is a funny business. Like, I would never want to go into politics.
I think it's failing us.
Yeah,
I think
really
it's failing us.
Yeah, I mean, the choice of candidates as well.
Yeah,
like, you just think that there'd be more opportunities. It's not like the American system has necessarily generated, super compelling candidates. And it seems like the compelling candidates in the US system are also, for whatever reason, there's a lot of attrition. Like, guys that want to, the people that seem to have a lot of ability, they seem to flame out for one reason or another. You get these highly bifurcated, polarized environments where you get a Biden versus a Trump. But I think the difference with Trump this time around, mate, my final comment is, and I'm not politically partisan, I don't think myself, and I thought Trump Mark I was pretty mercurial and capricious and hyperbolic and everything that people criticize him for being. But this dude has had his ear shot off. He's had multiple assassination attempts. He's coming up towards 80. He's only got 1 term. There's no 3rd term at this point. He's not kind of doing this to win another election. This is all a legacy trait, and that's why I think he's going for the jugular. He's really serious, and that's why there's been no Trump put option for the market. The market keeps on thinking he's going to acquiesce and he's going to bend the knee and say, "Oh, it's all okay. I'm just trying to negotiate a good deal." But he, I think, is really, really focused on far-reaching reform that's going to be his personal legacy. He wants to change the US. He does want to make the US great again, and so I think it could be a very turbulent, volatile time. And it's certainly an extremely uncertain time. So, policy uncertainty is heightened, and that makes decision-making hard. So I think for markets, tough for the next 6 to 12 months. At some point, that manufacturing miracle will assert itself, and the markets will start focusing on that. And that's where I think you can see a recovery. But I think in summary, in 2025, rate cuts from the Fed and the RBA, disinflation in Australia, high inflation in the US. I do think we're in the medium term in a higher for longer environment, particularly when the manufacturing investment starts coming online. So I don't see massive rate cuts. I do think that people that are struggling under the weight of high interest rate burdens, businesses and households, the marginal borrowers are probably going to continue to struggle. We've got record high insolvencies in Australia, but we also see the same thing in the UK, US and New Zealand. And I don't think that's really going to change fundamentally. I think we're still living in an inflationary world, but there's these cross currents now because of the trade war.
And where can people follow your updates?
So on Twitter at Joye, on LinkedIn, we publish our macro strategist, Kieran Davies, publishes on Livewire. And then I publish weekly in the
So livewire.com it's a free service because I subscribe to that. Coolabah, you got a publication in Coolabah?
We've got our website, coolabahcapital.com. And then in the Financial Review, that article, that column I write publishes on Friday and then appears on the paper on Saturdays, most weekends.
Chris Joye, thanks very much, mate.
Thanks, mate.